Markets change. The unknown unknowns are what move markets, while the known unknowns are already priced in. Declines happen, but history shows they've all been temporary. The advance is what's permanent. I'm Mike Bishop.
And I'm Michael Bishop.
As fiduciaries, with decades of combined experience, we've helped investors navigate the noise with a disciplined, long-term plan. The key to success is acting on a strategy, not reacting to headlines. Welcome to the Fiduciary's Edge, where we break down the risks, opportunities, and realities of managing wealth the right way. Let's dive in.
Welcome to episode 1 of the Fiduciary's Edge. My name is Michael Bishop, and this episode we are calling Why Investors Get in Their Own Way. I am joined with my dad, Mike Bishop, or as I sometimes call him, the other Mike Bishop, and I'll let him introduce some of his professional credentials.
Michael's great to have you. I am Mike Bishop. My wife and I, Maureen, founded our firm in 2008. My background prior to that was really focused on finance all through undergrad and investing. And one of my professors in school encouraged me, if you really want to get into money management, the designation that'll break down a lot of doors is the CFA charter, which is the Chartered Financial Analyst designation. So that was 30 some years ago that I studied for that. And that did open a lot of doors and got me kind of good footing, background training, supplementing undergrad. And Maureen and I started Bishop & Company in 2008. And Michael, fortunately, has joined us this past summer in July. I'll let you talk a little about your background, but we're thrilled to have you on board.
Yeah, happy to be here. A little bit about me. Originally born and raised in Erie, PA. I went to John Carroll University in Cleveland, Ohio, studying economics. And with that, I was part of the 3+3 program with Case Western Reserve School of Law, where I was able to do my law training, my legal education. I focused mostly on business law. I got a business concentration upon graduation, taking so many business courses. And then I worked in transactional law in Erie for the past couple years. I was doing everything from business transactions, mergers and acquisitions, some tax work, estate planning, trusts. So I had a wide berth of business and taxation experience, and just decided that the practice of law was not my cup of tea. So I was fortunate enough to have a great investment management firm willing and able to take me on as an associate advisor. So it is great to be here.
And now you're pursuing?
And that's right. And now I am studying for my CFP designation, Certified Financial Planner Practitioner designation. And so that is, as we've talked about, that's really rounding out my experience here. It's a great overview of things I had seen in my practical experience in the law firm, questions that people had, common questions that come up in estate planning. And then also things that we do here, investment management focused on financial planning, developing plans for clients, which is what we do every day.
Yep.
So
I'm excited because that's going to supplement my training, which was very core security analysis, portfolio management, economic analysis, and you're coming at it with your law degree and also the CFP, more of a planning. So I think that adds a lot of dimension, helps our clients quite a bit.
Yeah, I think it will. And, I think this sets us up really well for this first episode conversation that we're having, the common pitfalls and why investors get in their own way. I mean, between the two of us, we have pretty extensive credentialing. We deal with all sorts of people from all sorts of different backgrounds, everything from business owners to teachers to and everything in between. But, why is it that investors seek money managers? Why can't people just do this on their own? And as we've talked about, there are so many, even though we see a varied population of people, there's so many common pitfalls. Like, so many people will fall for the same psychological traps or just caught in the same sort of reductive thinking about it. And so I thought this would be a good opportunity for us to really explore that and why, where our value add comes into a lot of these people's lives. Because the business that we're in is truly lifelong relationships. And that's something I've really
Yeah.
come to enjoy over the past years, that we're not with these people for 3 months developing, an estate plan package. We're with them for 30 years, watching their kids grow up and figuring out how their financial goals change with all that.
Yeah, it's amazing. Really are.
So, I guess the first thing that we should really talk about, and we talked about it a little bit already in prep before, but is, very common investors fall victim to herd mentality thinking. And, I think as we're sitting here today, perhaps there is a little bit of herd mentality happening in the equity market right now. We're recording this on March 28th, and this morning it seems like every line on my phone is red and going down.
Yeah.
And so part of that, people will ask us very bluntly why, or if they think there's one variable that is causing this. And so they will attach to that and move with the herd. But you've got a really good analogy that you tell to clients that they're able to attach to about is it the bulls and the buffalo?
Yeah. Well, to add to what you're saying, it feels comfortable. It feels safe when you agree with the herd, when you're part of the herd, to be countercultural to that, to be kind of the standalone, the obstinate going in the other direction. It feels risky. It never feels good when you're the only one, making a position or a trade that's against what everyone else is saying. And you don't get that reinforcement that if everyone else is thinking the same thing, I must be right. Usually when everyone's feeling the same way, you go back over market cycles and you look at when the herd's all leaning on one side, either very bullish or very bearish, almost always the market turns the opposite way. But to your question, this is so funny, but it's very true. The human psyche is not built to be a good investor. We just have a constant sense of we're scanning for danger, and we perceive danger even when it's not there, and we get confirmation from the herd that we should run the other way.
Yeah.
So as an example, if you look at when a storm is approaching and there's cows in a pasture, as the storm's coming up over the horizon, the cows will actually see the storm clouds and run away from it in a herd. And the herd builds and grows, and then they get comfort that we must be doing the right thing. They keep running away from it to avoid it, thus prolonging the pain and enduring the entire storm and the anticipation of it. Buffalo, to the contrast to that, will see a storm and run directly at it, full throttle, right at it, minimize the pain, get it over with. And that's counterintuitive to how we've been trained to invest. When prices are falling, no one wants to see that happen. You want to run away, stop the pain, get out of it, what the herd's telling you to do. And that's very difficult.
Yeah. And do you think that part of that herding, if there's observable herding in investing, do you think that has over your career gotten worse? And by worse, I mean, during your career specifically, I think you've had a really unique opportunity to view the bleeding edge of technology, how it has made access to information so easy on any number of topics, perhaps especially financial information. And, we joke facetiously about how there's traders on the Chicago exchange that will try to have their offices as close to the exchange and run fiber optic internet to have the absolute most up-to-date, fastest information.
Fastest pricing. Get it before anyone else. Yeah.
Yeah.
So and they can act on it quicker. Yeah.
Exactly. And now everyone has that information on their phone. So has that, do you think, contributed to this?
Fascinating. When I started in this business 33 years ago, I remember every Monday morning we had one computer in our department, and my manager, who was a money manager, and I was just an analyst for him, he would come in Monday morning and throw a value line paperback 70-page report. We would get one a week, and it would have 70 companies in it roughly. And I'd have to sit at his computer and enter on, do you know what Lotus 123 is?
Heard of it.
I'd have to enter in a spreadsheet the earnings estimate for the year that changed from the last time they did it, which was 6 months prior
Yeah.
for those 70 companies. And then he would get that spreadsheet and run analysis on it and try to figure out valuations. Manual, like that was the latest information. He'd be like, hurry up and get that done. I want to look at the numbers. Now, as we're sitting here, computers are analyzing all that data instantaneously. They're doing second derivatives on momentum growth. I mean, it's beyond even human input. It's before you can even think about it. There's so many more people today digging through that haystack, looking through the needle. There's so much more information and so many more eyes looking at it. But to answer your question, no, I don't think people have gotten better or worse with their behavioral decisions. I still see the same repeated stuff that we're hardwired to do today as I did 30 years ago.
That is so fascinating. And do you see, wow, that is just so interesting, in that technology hasn't had perhaps that much, in your opinion, of observable impact on the herd mentality thinking. Is there a generational element to it, you think, too? Because I remember early in your career telling us about a lot of your clients who were children of the Depression, and they all have very specific, similar views about money. And have you seen their children carry that, change it in specific ways? I mean, is there a generational herd?
I would agree with that. I'd say there's almost financial traumas from when people were raised, not how they were raised, but when. So that Great Depression babies, or their parents were of that era, and they kind of infused that to them at the breakfast table when they were, little kids. And they almost have an innate fear of what they a lot of times will reference in our meetings, the stock market. The stock market destroyed my parents' wealth. Where you go out 3 generations from that, they don't have any relevance to that, living that horrible Great Depression period.
Right.
So they don't have that innate fear, but almost they're more emboldened that they think, well, I can get this information on my phone, or I can access these different databases. Almost emboldened and overconfident, don't understand how sharp the game is now, that with more information, you have even less of an edge to beat the market.
How about the other side of that coin? That, to some extent, maybe we can call the cows in this example as sort of the very anxious. They are not confident about their own financial decision making, and so, as you said, there's comfort in moving with the group of people. What about people who, not to say that they're going against the herd per se, but who are just overconfident in their own skills, that they know exactly why the market will move. They think they can time it. They believe themselves to be the reincarnate Peter Lynch. You talk about that. I mean, do you see that same, how that same thinking can cause pain for investors as well?
When I think about economics and how markets move and just think of our economy. And our minds can't even comprehend it, but a lot of people will say, if I change this one variable, if I'm confident this one thing, an election, the Fed will do something with interest rates, there's some event that I'm going to flip this switch and make that happen, and therefore I'm going to build a thesis of what will happen after that. There's no crystal ball. That no one really knows what will happen, because there's so many variables that are codependent on each other. So when people make that scenario of, I'm going to look ahead, I'm going to change one variable, and therefore I know what the market's going to do because I know what the economy is going to do, they're forgetting that all the other variables will move too.
Yep.
So as an example, this classic example, literally 5 years ago right now, so February of 2020, you were in law school, so you remember how horrible that was. The world,
Zoom School of Law.
Yep. The world shut down. Like Disney World was closed, airlines were grounded. You were not going to class.
Yep.
We were getting groceries delivered in our driveway, and we'd wait till the driveway and open the garage door so we didn't get anything. It was nothing. I mean, my grandparents didn't even have that in this situation. So that was February of 2020. Within a month, because the world literally closed for business. The equity market fell a third in a month. Never happened, not even during the Great Depression, never happened that fast, that hard before. And all of a sudden, literally this week, 5 years ago, early March 23rd, 24th of 2020, it stopped going down and did an about face and turned and never looked back. By August, all the losses were recovered. But so many people, I remember talking to people saying, we're going into a Great Depression. I was worried we could be going in a Great Depression.
Yep.
There's no commerce. Like the Fed is going to float money out there to keep us afloat. No one's traveling. No one's in hotels. The world has changed. And how long is it going to take to get us back to normal? But the market, despite all those prognostications, the market didn't care about that. The market looked ahead and said, we will solve this. We don't know how exactly or when exactly, but we will come out of this and we will come out of it stronger. So, as I said, by August, all the losses were recovered and it just kept on going. So people who held on to that belief of, I know what's happening, they missed it. That's the really hard part about investing, is trying to get your ego of what you think is going to happen out of the way and maintaining just a kind of a resilient faith that it will work out. I don't need to know how, but I know that it will.
And I remember this week, you gave that story, the COVID story, where for some reason we got to that point and it stopped going down and started going back up. I mean, I think that's kind of our entire thesis with investing, right? Is that you can't time the market. That means that you're never going to know when it's going to go down. The other side of that coin, the same coin, is you don't know when it's going to start going up. The bottom is the start of the top. Like the inflection point has no mass. It is, if you try to get it after you see it bounce, you've already missed it. And so I thought of the analogy, you got to keep your wings out the whole time on the way down, because as soon as it starts going up and you're not already in it, you miss most of it. You miss most of the recovery.
The key thing that you said there that is so imperative that almost no one intuitively gets is it's combined as one.
Yeah.
It's not separate. You can't get all the ups and not the downs. Like the reason you get premium return in equities, it's the efficient market's way to compensate you for the downs.
Let's take that to its conclusion. Like, if you could time the market, if you had a crystal ball and the lady inside of it told you when to sell with 100,000% accuracy and when to buy back in, like the moment to get back in is right before the bottom.
Yeah.
But definitionally, that's unknowable. So take away your crystal ball. No one knows the moment before the bottom. And if you can see light coming from the bottom of the rocket ship, you're already off. You've missed the ship.
Yep, too late. So last year we lost probably one of the greatest investors ever in my lifetime, maybe forever.
Yeah.
Charlie Munger, Warren Buffett's partner. And his famous saying, which I think is the gold that he left us, was never interrupt the compounding unnecessarily. Yeah. So to your point, missing, like there's been study after study that have shown you take a 20-year period and you happen to be out during the 10 best days.
Yeah.
Not months, days in a 2-decade period, you have your return.
Wow.
And to your point, if you go back historically and look at all those inflection points, the big downturn bear markets, and when it turns, the turn is as violent as the downturn. It's like right there. If you're not there to catch it, yep. you destroy yourself. You'll never get it back.
Yeah. And maybe to beat this point to death too, if you miss the 10 best days in the market, if you
10 best days, you miss half the return, roughly any 20-year period.
Again, let's just say in a perfect world, you've got that crystal ball, and like putting money into your account can take a day to settle. Like if you're rolling over an account, that can take 2 or 3 days. Again, not to say that you can even attempt to time this, But let's just say you try to, and to move some of your own personal positions around to actually catch all or as much of the upswings. It's like you're just never going to do that. There's no way that you can aptly do that. And, speaking of Charlie Munger, that brings up a great point, is if you can't predict the bottom, which means you cannot predict when the rocket ignites, you ought not interrupt it at all, because you're just never going to know when it's going to get better or worse. And
well, you've seen, since you've been here, you've sat in countless meetings and heard me go over and over. But you see the mantra and the onboarding of, we get these downturns. They have all been temporary. Sometimes, about one every 5 years historically, we really go down. We lose about a third. The equity market goes through a bear market. Historically, about every 5 years, you lose a third, and we don't know when they're coming. You just said that. It's part of the process. We have to endure it to get all the upside.
Yeah. I just thought of this too on, that's part of the plan and you said it yesterday in a meeting, where the plan is not are you an 80-20? Are you a 95-5? Are you a 100-0? What bonds are we looking at for you? That's not the plan. That's your investment mix or your allocation. But the plan is, are you invested that whole time? And I just thought of this off the top of my head. I watched Lord of the Rings last weekend, all 3 movies, which is an endeavor because each movie is like 3 hours long, but I love it.
With all of your studying, you were able to do that.
Oh yeah, I made time for it. And when Frodo's going to Mount Doom to destroy the ring, the plan is to, the plan for retirees is to retire. The plan for Frodo is to throw the ring in the mountain. The plan means walking through Mordor to drop the ring in the fire. The plan for retirees, you're going to endure downturns in the market. That is already part of the plan. We're looking at that already for you. For long-term investors, they're going to endure how many of these over the course of their life, on average, do these recessions or corrections come?
That's a great point. Portfolio is not the plan, because people will hold the portfolio in up markets, and as soon as we go down, we're in a correction right now. As soon as we go into correction, if they think the portfolio is the plan, they think it's not working.
Yeah.
I need to do something to change it. And that's why we get them to hold on to, where are we trying to get and when are we trying to get there? This is subservient to the plan. The portfolio isn't what guides the ship. So to your point, I burned this into my head. The year I was born, 1969, the year that we launched the Apollo mission to the moon, the Standard & Poor's Index, I'm going to have you guess. What do you think it was?
Oh my gosh. I couldn't even imagine. 1,000? Were we over 1,000 yet?
100. It almost seems like I'm missing a digit. So it was at 100 the year I was born.
Wow.
We've had, to answer your question, from the day I was born till, we don't know yet if this is a correction or we're going into a bear we're in right now, not including this, 12 bear markets, averaging about a 30% downturn. Went from 100, end of last year, it closed at 6,000.
Wow.
So what does that mean? 100 on the S&P closed at 6,000. Put dollars to it. A $10,000 investment when I was born went through 12 horrible, felt like end of the world. Three of those were halved, 50% declines, but just stick with it. As you said, never interrupt the compounding, let the dividends reinvest. You're paying the taxes from somewhere else or it's in a 401k. 10,000 end of last year grew to just shy of 3 million.
Wow.
So everything else is commentary. Like the news right now, it's horrific. It's scary. There's economic things that are happening that the market doesn't like. But we've seen shocks before, and we tell this to clients all the time, is that companies don't process adversity as victims.
Yeah. Yep.
They will figure out a way. COVID's a perfect example. We're going to come out of this leaner, faster, more efficient, and stronger.
Yeah. Yeah. Real quick, I think, you've got a good story about the Marriott hotels, how they were able to survive COVID. I mean, as you said, no one was doing anything, and we were receiving groceries as a household, I think in the same way we'd be receiving them as if we were in a zombie apocalypse. So how could a hotel company survive? But I think once you lay it out, it's such a great story that illustrates this point.
Think about, during COVID, no one is traveling. Probably one of the hardest hit companies on the planet, Marriott International, largest hotel chain on the planet. February of 2020, when the world was still open, to a month later, the stock halved.
Yeah.
They shut down 90% of their hotel capacity, furloughed almost their entire staff. But they didn't just sit there and say, oh, well, we'll wait till the world comes back and figure it out. Cut costs, change their inventory management. They actually use their call. When you call an 800 number to book a Marriott reservation, they sold that service. They got creative, and they went to the state of New York, who had massive unemployment claims that they couldn't filter it through their own service. They said, we'll be your unemployment office. Just train our people for 2 weeks what to do, how to process it. They charge the state of New York to sell their phone center out to do that.
So cool.
So they get innovative. They figure out a way of, we're not just going to lie in the ground and bleed out. They're going to figure out a way to earn a survival. And now, by the way, I just looked recently at Marriott, the stock is double what it was pre-pandemic.
Oh, wow.
So is the company doubled in size, or have they just gotten that much more profitable? Maybe COVID made them better.
We've talked about the behaviors that investors will engage in that ultimately hurts them. These, perhaps on one side of it, the anxious or timid investor is more likely to follow the herd, and that will result in perhaps premature selling or buying back in too late. And then the other side, the overconfident, they're probably too risky. They're not, and risky as in they're not as perhaps maybe diversified. They're more willing to take on more speculative investments or different speculative investment classes like crypto or real estate or something like that. And that ultimately will harm their return. A third thing that we haven't spoken about yet is sort of the reactive investor, because I think whether they are timid, cows running away from the storm, or overconfident, making, risky and irresponsible decisions, to be honest with you, that's still reactive. And so maybe talk about that. How have you seen that play out in investors' minds and your clients' lives?
It's everyone. Even me, when I look at our own personal portfolio, we own the same stuff our clients do, and I'm rebalancing in January for what happened last year. Your gut tells you, oh, wow, that fund made 30%. You want more of that.
Yeah.
And the funds that were flat, you want less of that. Just intuitively. Why wouldn't you? But it's almost intuitive that's what everyone wants to do, that I know that's the wrong decision.
Yeah.
Like, you don't want to sell all your losers and chase the winners. So my entire career, the epitome of that behavior problem, you were probably not even thinking about investments at this time, but
I've been locked in the whole time, man.
So the lost decade, which I still have clients quote to me of, there was a decade where we didn't make any ground. So the year January 2000, for that entire decade through December 2009 or December 2010. That 10-year period was a real anomaly. And then if I bought on that point and never touched it, I barely eked out a 1% return per year for that whole decade. It was very, very disappointing. There was a huge bull market at the beginning, massive collapse at the beginning, and then a massive collapse 2/3 of the way through, and then a recovery. But point to point, almost no return. So the market was flat, and most professional money managers have a hard time beating the market.
Yeah.
So the market offered no return really during that decade. There was one fund, and I remember seeing this and people talking about it. It's called the CGM Focus Fund. And in a decade where the market earned almost nothing, This fund's posted return, like the annualized return in their prospectus, was 18% a year plus per year.
Whoa.
Fascinating, though. It's like, wow, that manager really had the magic touch. Almost no one got that return, and not even the shareholders in the fund. Like, you look at that, well, how, if they own the fund, how did they not get the 18% a year? It's because they did analysis and looked at the dollars that were in it, when they were in it, and then they got out of it. Not everyone bought and held. Almost no one did that. They got in after the run-up had occurred. They saw it was just screaming hot, and they wanted to buy it. They got in at the top, as you're inferring there. Then it would have a major downturn. They panicked and sold out. Then it rallied again, and they got back in at the top. So just there, even they found the right investment in the worst period of time, they did the wrong thing of getting in and getting out.
Yeah.
Just overconfidence of, oh, I got to stop the pain, or I better get in because it's going to just skyrocket and I'm going to miss it.
Yep.
And that's just over and over again. I see that behavior.
Oh my God. It's almost like Shakespearean, that it's like you can see it coming. It's like I feel like it's everyone in the zeitgeist is where it's like, oh, you buy low, sell high, and then no one can do that,
right,
which is
right,
ironically funny. And I think that ties nicely into another point I've heard you make a lot with clients is, in some ways, this is like, this is me, not your example, but this is like conducting an orchestra in some ways. A lot of what we do in financial planning for clients is we are coming in as part of their ultimate sort of estate planning, general financial planning, educational planning, planning for their kids and grandkids perhaps too. And, whatever side of that coin they're on, overconfident, underconfident, to borrow a Michael Kitz's term, whether they are delegators or not, they're looking to someone who can cut through the noise and direct them. And you tell this to clients as there was only one Eisenhower on D-Day.
Yeah.
And I think that is such a great way. I think that just immediately resonates with clients.
Oh, I do love that. That's sometimes hard to tell people because we're all biased to get our information from what our ideology is or what our political views are,
right,
or kind of our bent. And we try, as you know, since you've been with us, Maureen and I try really hard, the sources that we lean on to get information, that they almost act like the market. The market doesn't care if you're Republican or Democrat. It doesn't care what you think's going to happen.
Yep.
It doesn't care what you paid for your investment. It will act in its own best interest.
Yep.
And we try to get information that we can act unbiasedly, that we're fiduciaries for our clients. We're not coming from a certain angle, but how can we protect and grow their money the best? So your example of Eisenhower, if when you're building that plan, sometimes people say, well, I'm going to interview a couple different money managers and maybe I'll spread it around and see where I feel comfortable. That sounds good on paper. That creates a lot of inefficiency. It creates overlap and duplication.
Yep.
It definitely creates a higher fee versus having all with one. But most importantly, when the seas get rocky and things don't go well, if I've got multiple generals telling me this is how we get through it, that creates confusion and it serves no one. So going into D-Day, I mean, you studied this. You probably know more about it than me, but Eisenhower had a plan of how the Allies were going to attack Germany.
Right, yeah.
How they were going to push the Nazis back. And Montgomery,
the British general,
and then Bradley, the other general of the three, vastly different opinions.
Yeah, oh yeah.
In fact, Montgomery was like, this is going to fail. This is a horrible way to do it. And it was decided, Ike's calling the shots here.
Yeah.
We're going to pick one. We're going to follow his plan. And can you, just like you elaborated to me, how that there were things that were not in their favor.
Yeah. I think when we say that, just to be precise about it, that there was only one Eisenhower on D-Day, you should only have one investment manager calling the shots in your financial planning. We don't mean that from the perspective of 2025, knowing that D-Day was a success, Allies landed in Normandy, and then within less than a year, Hitler was dead. We mean that more from there was a lot of doubt and fear and failure points and on the brink of catastrophe, that this could have been the end of the Allies' ability to open a front in the Western part of Europe that Stalin was begging for so long. I think that's the value of having that one Eisenhower on D-Day. You know, they delayed D-Day a day because the weather was bad on the day that it was actually supposed to be. The night before, as you told me this actually, Eisenhower penned a letter that was his resignation, taking complete ownership of if it had all failed. You know, I know there was some discussion of, I don't think the Allies were completely aware of whether or not there was an SS division that had been moved down to Normandy from nearby Belgium, and that would have ultimately destroyed the ability to get any landing craft on the beaches. So there was a ton of risk, and had this failed, I mean, you seriously would not have had British and American troops re-entering the European theater of the war for at least, I mean, I don't even know. I don't know how to play armchair historian beyond that. But all that said, one Eisenhower on D-Day, and it was successful.
Yeah, 3 different generals calling the shots could have destroyed the thing.
Yeah.
So when we meet with a prospective client, we tell them, we hope you pick us. We hope we're the right fit. And for us, too, we want to make sure it's a client that we can work with and they understand what we do and what we don't do. But if it's not us, they should pick that person that's they're going to place their confidence in when things go wrong. That's really important to start with that.
And ultimately, that one person, you know, whoever that is, whoever the Ike for you ends up being, has to, I mean, fundamentally, the reason that there's one Ike is so that, to go back to Charlie Munger's maxim, the compounding is not interrupted unnecessarily. If you had Montgomery and Omar and Eisenhower all launching 3 different amphibious invasions of northern France, there would have been chaos among the Allied command and resources and, you know, any other number of problems that could have ensued. So if you have multiple advisors, that will perhaps interrupt your compounding unnecessarily because they don't have access to your full financial picture.
Right.
That, you know, as investors may see that as, to some extent, it's like, well, I got a couple different guys working for me and, you know, he's doing his thing and he's doing another thing. And to the extent that that feels good for a personal investor's ego is, I think, the only benefit that it's giving them. I mean, it's ultimately hurting return because there's not one Ike on D-Day.
Yeah, true.
And this is just so apt for this too. You know, a lot of our philosophy, I think, also boils down to you can't time it. You can't call the bottom, so that means you can't call the ascent. You can't, you can't beat the best of them. The Peter Lynches and the Charlie Mungers and the Warren Buffetts come and go. But ultimately, that's not the game you're playing, is to be like the next Gordon Gekko. You make it, you compare it to the game of tennis. And you say, how do you bring that home?
So 34 years ago, when I was sitting at the kitchen table studying for the CFA exam, just hundreds of hours of quantitative reading and financial statement analysis, DuPont ratios, capital asset pricing model, all that accounting stuff. One of the required books was a little tiny skinny book. Took me 2 hours to read it. It was called A Loser's Game by a guy named Charlie Ellis. And I'm like, what do I have to read this? There's no analysis in this. There's no formulas in here. There's nothing I could take to the test. It's just all this concept. Out of all the stuff I had to read those years, that is the most resounding thing that has stuck with me. So Charlie Ellis, famous investor, he was the chairman of the board at the Chartered Financial Analyst Institute for some point. And he wrote this book many years ago and said, playing tennis well is very similar to the game of investing. and what he said is, if you think about that, you've played tennis and pickleball.
Yeah.
You think about the game of tennis, 99.9% of people that walk onto a court, amateurs,
Yeah.
their goal should be one thing. When the ball comes over to them, it should be get it back over the net in play. That's all you should try to do.
Yeah.
And when it comes back again, get it in play. Most of us, though, try to put speed on it, place it, spin, hit it in a corner, get our opponent to run, and we basically create a fault for ourselves.
Yeah.
You want the other guy to lose the game. All you want to do is stay in play. And he talked about that's the same in investing. Don't interrupt the compounding.
Yep.
Never do something to hurt yourself. Just always be in play. Don't get out of the market. Don't try to time it. Don't chase things that have gone up. Don't panic out of a diversified portfolio just because the market's down. And then he took it a step further, which I've seen, you've asked me this a couple minutes ago, I've seen over my career that even that 0.1% of professional, I'm not talking about tennis players, but investors. So the very few percent of people that are placing trades that are professional traders, I don't think they have an edge. Even 30 years ago, I think it was hard when I first started in this. Now, with so many more people and computers and AI digging through that haystack again, and you look at the numbers, that something like 85% in a block of time, 85% of the smartest people on the planet making trades, professional investors, can't beat their own index. So it's not like these really smart people with the best information that know better are any better than the average person. It is so fine of a refinement that when I was starting, the objective was we can provide performance. We can outperform the market. No one can do that. And even people that say they can, it's consistently, statistically impossible. The numbers prove that. So it's shifted from outperformance to reaching a goal. You don't have to outperform the market to be wildly successful and reach your goal.
Right. Yeah.
But some people still feel like if I can beat the market, I can take my family on a really great vacation, educate my kids, and retire in comfort. And it's like, no, if you have a plan that accounts for all that and we fund it and stay committed to it, that's what'll get us there.
You used the word edge there. And to bring it all home, I think that is the fiduciary's edge. I think that is our advantage that we can provide clients as our value add, where, you know, most investors are going to fall victim to herd mentality. They're gonna go on TikTok and Instagram and Twitter, and they're gonna turn on the TV and see this, that, and the other thing, whether it's political or financial journalism or opinion pieces, whatever. And they're gonna be feared and left to their own devices. They're not going to make prudent long-term investment decisions. On the other side of that coin, people who are overconfident are going to perhaps throw too much money into a stock they personally believe is undervalued, or that r/Wall Street Bets thinks is undervalued, in an attempt to beat the index or beat the market. So, you know, I think the fiduciary's edge is helping investors stick with the plan. You know, as we said in a meeting the other day, it's keeping the faith. Not necessarily. I mean, because we're looking at all those economic indicators, and we're not crunching the numbers by hand like you were at the start of your career anymore, but we're interpreting that data and making investment decisions for our clients, how and where we feel we need to. But ultimately, that is easier than keeping the faith, is what it sounds like over the course of your career you've seen clients fall victim to, is not missing that $100 payment that they're putting into their IRA or whatever it is. It is believing that they need to stay invested, stay perhaps more aggressively invested than they think they need to be for their age, but ultimately keeping the faith and don't let the compounding be interrupted unnecessarily.
Yeah. Just to add to that, summarize that, we had a meeting, you and I were in a meeting just this week with a client and her younger daughter who's new to the world of just kind of getting started and understanding it. And we showed her just incrementally, as you said, keeping the faith with a plan, what it could achieve. And I think she was pretty taken back by what it would compound to over her multiple decades before retirement. I mean, it almost seemed like we made a calculation error because the numbers got egregiously large. But when people can hang on to that, when it all starts with a plan. Early in my career, 30-some years ago, we didn't build plans for people. It was, we've got a black box portfolio. We're going to add outperformance, and that's why you're hiring us. We can pick stocks better than anyone else. That's what my manager's literally brand was. That's what we would try to sell. Now, I see so many errors in that. We build a plan, help clients stick to that through really awful times. Like when we first started our company, within a year, the market halved.
Yeah.
I mean, it was a horrible time to start a company. And now it's up 4+ times from the day we opened the door. But staying committed to it through thick and thin, that's critical. I think that's what we're charged with as fiduciaries for our clients.
Well, Mike kicked things off, so I'll wind us down. Why'd we choose this topic for our first episode? Simple. Because successful investing isn't about just returns. It's about building financial security that lasts. By understanding these common pitfalls and maintaining a disciplined approach, you can safeguard your wealth for the future. Thank you for tuning in to The Fiduciary's Edge. I'm Michael Bishop.
I'm Mike Bishop.
Until next time, invest wisely. Thanks again for tuning into The Fiduciary's Edge. We're on a mission to teach people how to avoid herd mentality by focusing on the decades rather than days. If you want to learn more, watch out for our quarterly newsletter and podcast. And as always, all views and opinions expressed in this podcast should not constitute financial or legal advice. Past performance is no guarantee of future results.